Welcome, welcome. I'm your professor, Steve Wallen. This is Homework Help, Chapter 5. You ready? All right, let's go ahead and do this. Chapter 5 right here. Buckle up. Let's do this. Here we go. Okay, in the table below, calculate the marginal physical product for each successful worker. Answer 2 questions about production. I think we can do this. Calculate the marginal physical product of each successful worker. Okay, this is one of the big things. Whenever someone says marginal physical product for each successive worker, they want to know how much is each new worker adding. Okay, so if I add one worker, what's that new worker going to actually produce? Okay, so here I go from 0 to 1, so there's 1 in there. Okay, that's a change of 1. Sometimes when you get into more complicated stuff, you have to kind of, your labor inputs aren't as nice and neat as this, and you have to add them in chunks. This one we're just adding 1 at a time. And our pair of genes goes from 0 to 15, so what's the difference between 0 and 15? 15, right? 15. So, marginal physical product's going to be what? Well, we had 1 more worker. We got 15 more units, therefore, should be 15 here. That's how much 1 worker that we added gave to us. What happens on the next one? Let's see. Next one, we still got a change of 1, right? So, what's the difference between 1 and 2? Still 1. What about between 15 and 34? 15 and 34? Do the math. What's 34 minus 15? Well, 15 plus 15 is 30. Okay, so at least 15, then add 4 more, it's going to be 19. So here, there's 19 between them. Okay? 19. So for this additional worker this time, we got 19, so we became actually more efficient here. Things started going up. Okay? Here, what's the difference between 2 and 3? 1. Okay, so 1 more worker. What about between 34 and 44? 10. That's it. And so the next one's going to be 10. So whenever you think about marginal, just think about how much more does the next worker add to what I'm doing, okay? So the first worker added 15. The second worker right here added 19 more units. And they have a running total down here, 15, 34. The third worker added only 10, which gets me to a running total of 44 total units. All right, so we kind of see, this kind of gives us an efficiency of how much we're getting per worker as we add them, okay? So the first worker, we got 15. Second worker, they became more efficient working together. Third worker, well, efficiency dropped off, but still positive. What happens? Let's keep this going. So we added 1 more worker, and this worker, 44 and 48, only was 4. We added 4 more. What about this worker? 1, 3, 4, and 5. We only had 2 more. Man, we're losing efficiency. We got 5 and 6. Just a sec. There we go. All right. Between 5 and 6, we got 1. That's what's interesting. Between 6 and 7, we added a worker. We didn't even become more effective, okay? We got literally nothing happened because we added another worker. And then here, we had a worker, and we actually went -4. Why is this happening? Well, it's because we have fixed production resources, okay? So if I have a factory, and let's say that factory normally is meant to hold 3 people, if I put 4 people in there, yes, they can probably fit in there, and yes, they can be somewhat productive, but it's not going to be efficient. And if you put too many, if I put like 6 people inside of a factory made for 3, they're going to start bumping into each other, and they cause problems, and that's when you actually become negative. Okay? So let's go ahead and put all this in. 4 and 2. and 1, 0, and -4. Okay. Now, when we look at this, for which worker is marginal physical product? Okay. And they're going to say first diminishing. Okay. So when did it first go down? Well, from 0 to 15, it went up, right? So that's increasing. From 15 to 19, it went up. That's increasing in efficiency. What about from 19 to 10? That's decreasing, right? So on the third worker, we became less efficient. So number 3. Okay. So it went from 0 to 15, 15 to 19, and then 10. We're still increasing overall as far as total, but our efficiency per worker has now gone down. And then, if we come over here to 0, when did it become 0? Right there in the 7th worker. We'd see if we did it right, shall we? Let's go ahead and check and see. And we got it. It's all there. So the main key takeaway is this. Just find the differences between them all. If you look at here, all these right here, there's 1 worker difference between everything here. And here I found out, I took between 0 and 15, between 15 and 34, between 34 and 44. I found out the difference between each of these to figure out how much each one of these workers actually added. And that's their marginal production per worker. Okay, that's how much they were actually adding. Next question. Ooh, we got a lot of math here. In the table below, compute average fixed costs and average variable costs for all rates and output, and answer 3 questions above about average costs. All right, so let's go through and do this, shall we? Rate of output 10, fixed costs 20, average fixed costs. So let's go in the theory of this first. Okay, let's look at the theory. Theory is this. Boo-da-doop, doo-da-doo. But these are our costs for our business. FC, fixed cost. Okay? And this is the price, or how much it's going to actually cost us. This is the quantity. Whether we produce 1 or 0, well, let's do 0, or 10, does fixed cost change anywhere? No. But the amount that each unit is covering does change. And that's all we're doing, is we're talking about average fixed cost. So if I have a factory and I produce 1 donut, well, that 1 donut then has to cover all my fixed costs in that factory. It has to cover the rent, the land space, insurance, you name it. But if I produce 100,000 of them, then every single one of those donuts gets to work towards my fixed cost and makes my average fixed cost go down because I'm not having to put that much overhead into everything. Okay, things that I have to have regardless. So let's see how this plays out. So we come over here. Let's go ahead and get our calculator, shall we? Okay. Calculator. So all we do is you just take basically what's here. See that fixed cost of 120? Then you just divide it by how many are there. So 12. That's it. That's all I did. And then you're going to do it over and over. Fixed cost 120, but if I'm producing 15 units, each one of those units gets to cover a portion of my fixed costs that I'm having to incur. So I go 120, divide by 15, 8. And you're going to see a pattern here. Take notice. See what pattern is coming up, okay? I go 120 divided by 20. It's now at 6. Seeing a pattern? All right, keep a look at. Keep noticing this pattern. Now we're going to do 30 or 120 divided by 30. Now we're down to 4. So in other words, if I keep producing units, what's going to happen to my average fixed cost? My average fixed cost will almost always do what? If I keep producing units. By default, it's going to go down. That's correct. That's it. All right, so then we go 3. And then 120 divided by 50, 2.4, and then 120 divided by 51 equals 2.35. Might need it. Nope, 2.35 looks right. Okay, that's it. That's all you do for average fixed cost. Let's check it, see if we did it right. All check marks. So the rule of thumb is the more units you have spread over a fixed cost, the cheaper that is your fixed cost contributing per unit. Okay, so if I made 50 units and have a fixed cost of 120, that means $2.40 goes towards each one of those units, is kind of taking care of my fixed costs. If I'm kind of splitting up my fixed cost amongst all those units. Let's do variable costs. This is where variable comes in. Let's go ahead and draw this on the map over here. However, as a business though, I also have what are called variable costs. So fixed costs down here, that's like rent, that's land, that's whether I produce 0 or 10, it stays the same. Okay, that's how you know it's a fixed cost. Other costs you're going to have in the business might be materials, okay? So you could have your raw materials. You could have your labor. You could have many other inputs that change as you produce. Those are variable. So right here, when variable and fixed costs meet, it's going to be 0. You're going to have 0 variable costs. But as you produce more units, like say you're producing 10 units here, your variable costs are going to go up. In fact, if you're producing 10 units here, what do we see? Rate of output 10, variable cost 85, okay, 85 here. And then at 10, my fixed costs are 120, which means right here, if I was to do a line that goes right here, it hits about at the 10 mark. This is going to be 85 plus 120 will give me 205, and we call this TC, total cost. And as we can see, it's right there. Right there they put total cost. All right, perfect. Let's go ahead and calculate all these variable costs then, shall we? So, with all these variable costs, let's go ahead and put these all in. Let me go ahead and clean this up so you can actually see the calculator a bit better. There we go. Okay. So, all you do is you take your variable costs, which is 85, and then you're going to do what? Divide it by the amount you're producing. So you take 85, divide it by 10, meaning the variable costs at this low production amount is $8.50 a unit for variable costs. And the way you can double check this, you notice they actually already did total cost for you. If you take 12 plus 850, you're going to get your total cost per unit of 2050. So you can easily check this based on this over here. And then you keep working it. Keep working it. Get it going. All right. 125 divided by 15. So we're taking this number, divide it by that. Okay, 8.33. And then we keep going. We can go 150 divided by 20. So we're producing more units. Notice this, we're producing more units, but each time we produce more units, we incur, because it's variable, more costs, because we have to increase labor, we have to increase raw materials. So 150 divided by 20, 7.5. And you just keep going. This time we're going to have 240 divided by 38. 350 divided by 40. 875. And then I have down here 550. This is where it's going to get interesting. 550. And look at the pattern. The pattern's going to be different than average fixed costs. Look at the pattern over here as far as what we're getting in the numbers. Okay. So here we got 550 divided by 50. Gets us to 11. And lastly, we have 633 divided by 51. 1241. Point there. There we go. Okay. Now, the thing that's interesting in this variable cost is it starts out at 850, and then as we're increasing variable costs, we're kind of reaching this economy of scale, right? We're like, okay, now it's 833, then it's 750, and then whoop, what happened? It starts going back up again, okay? That's where it costs more. So maybe now you have to pay overtime for your variable costs. Maybe there's things that are going on where it's no longer as efficient, and also maybe you're just running out of room to really, for those people to be efficient in general as far as your factory, whether you're adding them in there and you're like, hey, we can get more done, but total done, but they're not as efficient as they used to be as far as adding in our variable inputs to produce more of these things. In fact, up here, it gets to be 1241 on variable costs, okay? However, our average fixed costs will always go down, okay? At what rate of output are average fixed costs the lowest? Well, as we keep going, they keep going what? Lower, because they keep spreading their costs of units over the entire amount. So it's going to be at 51 units. Okay, now this one's interesting. Rate of output are average variable costs the lowest. Well, the most efficient variable cost was all the way here at 20. Okay, that's where it was the most efficient. However, at what rate of output are average and variable costs the lowest? At rate of output are average variable costs the lowest. No, that's right, that's the one we just read. At what rate of output is the average total cost the lowest? Okay, this is the one we're on. We just add them up. So if you add up your average fixed costs and your average variable costs, that's going to give you your total costs. And where is it the lowest? It's going to be in between 51 and 20 units. We know that because you're going to have our 2 points there, and it's going to be most efficient at 40. 40 units. And so that's what's interesting. Even though we're becoming less efficient on variable costs, we're still spreading out our average fixed cost, and so it still makes sense to keep doing it from an efficiency point of view if we're targeting efficiency. And we'd go all the way to 40 if we want to be the most efficient. However, as far as actual production, you usually keep producing as long as you're making money. So as long as you're making money, you keep producing each of those units, even though you'll start seeing it become tighter and tighter margins. But once you stop making money per marginal unit, you stop in general. But this one right here, if we're looking for efficiency only, right there it is. And it's in between that one and that one. Let's check it, shall we? What do you guys think we're going to get? All green. Oh yeah, all green. All right, moving on. You guys survived that long math. Here's got some math, but it doesn't look too bad. All right. Given the following production function for Tight Jeans Corporation, calculate the marginal physical product, graph the production function, and marginal physical product on 2 separate graphs, then answer 3 questions. Okay, so we gotta fill out the table first. So, marginal physical product, that's the exact same as we did on the other one. The workers right now are changing by what? What are our workers changing by? 1 apiece. So from 0 to 1's 1, from 1 to 2 is 1, 1, 1. Each time we're just changing by 1 worker, right? Okay. And let's see how much the output changes by. First worker, output changes by 10 because we're going from 0 to 10. Okay, what's the difference between 10 and 36? That's going to be 26. So that's a jump up in efficiency, huh? 26 there. Okay. 36 and 56 is going to be 20. Sorry, it's hard to kind of fit this all in. So that's going to be 20. And then 56 to 68. Well, we go 4 to get the 60. And then we add on 10 more is 14. And then 14 plus 8 is going to be 22. Interesting. All right. And then 68 to 74. Oh man, look at this one. What happened to this guy? All of a sudden we only got 6 more on that. Oh, sorry, I did way more on this one. It should have only been 4 plus 8 on that one. I added an extra on there. Always double check your work. It's 4 plus 8, 12. There we go. Perfect. All right, and then 2. Two. Oh man. Sorry about that. 2. 0. And here we go. -2. All right, let's plug them in. Plug it in. 10. 20. Oh no, let's see. Yeah, it is 26, yeah. And then 20. 12. 6. 2. 0. And -2. Alright, let's double check this before we move on. That should all be correct. And we're golden. We're good. We got green. Green means we're good. Alright. So as you can see with our efficiency right here, we're getting more efficient, and then all of a sudden it drops down. We're from 26 to 20 per worker, 12 per worker. And this is the additional worker. It's the marginal. It's the one we just added. And then 2, then 0, and then -2 adding the additional worker. So it's not per worker, it's per additional worker. That's where you get marginal from. Alright. Production function. Plot the line points. This is how we're going to see how the efficiency. So we go here, and we just go up to our first worker at 10. And then we're going to go to our second worker at 26. Okay, then we're going to go to our third worker at 20. Oh, sorry, they want us to do the total, actually, on this. Oh, yeah. Quantity of output pairs. They want a total on this one. Reset this. Alright. So 0. This is right though. 1, 10. Alright. Then they're going to want 36. 2, 36. Then they're going to want 356. They're not asking for an efficiency function, they're just asking for a production function. They just want to know what's being produced. So 4 is 68. 5 is 74. 6 is 76. So you kind of see here, just kind of at the very top, we plateau, and then it even becomes negative. 7 is going to be 0, so 76, yeah. Zero efficiency. And we go over here. Negative 274. There we go. So as we can see on this, this is the production. Each worker we're adding is becoming super efficient, super efficient, super efficient. And then as we continue to add workers, they're not doing as much. In fact, at some point, they don't do anything by adding a worker, and we even go negative by adding workers after that. So there we go. Now, this is where they want marginal. Use the tool provided MPV to plot the line point. So quantity of output, labor output, workers per day. So now they want to know marginal physical product. So we go over here, that's where we'd be putting the 10, 26, 20, all these in. So first one is 1 and 10. And the second one is 26. This means the marginal physical product went up big time with that second one. Third one, it goes to 20. And then 12. And then it went to 6. And then it went down to 2. Sorry, 6 was 2. 6 was 2, okay. 6, 2. You can see that it's just super drop off it has. This one's going to go to 0. And then we actually go below 0. We go to negative 2. So as we can see right here, it's like super efficiency being done. And then it just goes bloop, 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 bloop. And just falls off. Okay. They might have wanted us to plot 0 and 0. We'll find out when we check it. It's a possibility they could, because I'm looking at this, they could have wanted us to plot 0 and 0 out here. We'll see though. Alright, the law of diminishing returns becomes apparent. At worker number what? What worker are we no longer getting returns? Diminishing returns and less per worker. Well, right here, and then boom, number 3, we're getting less. It actually goes down. So we're getting diminishing returns per worker. MPP hit 0. Boom, at 7 we hit 0 right there. And MPP became negative. Yeah, right there at 8. Alright, let's double check this. It might wanted us to plot the 0 point, so we'll find out. And it did. It wanted us to plot the 0 point here. And it wanted us... No, this one didn't ask us to plot the 0 point. Interesting. So with that one, though, it did want us to plot the 0 point. So it's something to be aware of. And then you just count points. It'll tell you like how many plot points total. 1, 2, 3, 4, 5, 6, 7, 8. So what do we need to plot? Plot 0 on there. So that's all they wanted there. And this one says plot 8 points total. 1, 2, 3, 4, 5, 6, 7, 8. So that's the other way you can check it. Just see how many plots they actually want you to do. And that way you know whether or not you need to include 0. Sometimes it's kind of known that 0 would be there, but sometimes they want you to plot 0. So, all right, but that's everything. And then all you'd do is you'd go back here and you'd add on 0, which, because it's dumb, it puts it at the end of the line, which is not where we'd want it. We go here. Nope, it'll always do it. So rather than replotting all of this, you just want to start there. That's all you would do. All right, let's go on to the next one. Here we go. Here we go. Let's take a look at this and see. Rate of output, fixed cost, variable cost, total cost, average total cost. Okay, this is 4 or 5. Compute the total profits at a price of 15 per unit. Okay, so let's write that down. 15 per unit, and an output of what? Output of 40 units. So we're doing $15. Okay, at 40 units is how much total revenue at 40 units? Well, just do the math. We'll just pull out the calculator real quick, make it simple. 15 times 40 equals 600. All right, so we got 600 we're working with. 600 here, okay. And what can we see over here? What's our total cost at 40 units? Well, our fixed costs are 120, variables 350, total is 470. So we just minus 470 from here. So we go minus 470 equals 130. So this is one way you can do it, and then that'll give you a 130 price. Okay, so that equals, and you're going to go 130. Kind of running into the calculator, so I wrote it off to the side. That's one way you can do it. We'll go and plug that in real quick. The other way you can do it is you can do what's called profit per unit. So this is total revenue minus total costs equals total profit. The other way you can run this is you can do what's called price per unit. So if I got $15 per unit, okay, 15 per unit, and at 50 my average cost is $13.40. All I do is I take 15, and it's going to cost me $13.40, so I'm going to go minus $13.40. So it gives me $1.60 a unit. So you just figure out your profit per unit. So all you do is take your sell price minus your average total cost. It gives me $1.60 per unit, and then I can just times that by the amount of units. So I can go times 50 equals 80. So you can either do it as a whole or you can do it per unit, and you'll still be able to get the same answer. Because I went over here, then I just times that by, like I said, the 50 units, because I'm making $1.60 per unit, and that gave me the 80. There we go. There we go. There's the 80. Perfect, let's plug that in. 80. Check my work. There you go. We're golden, we're good. Last one, you guys are almost through it. Almost through. All right. Suppose a company incurs the following: labor, equipment, materials. It owns the building, so it doesn't have to pay the usual $900 in rent. So let's go ahead and let's classify what type of things we got here. These are all accounting costs. These will all show up on the books. You have to pay out labor, it's going to show up on the books. You have to pay out equipment every month, that's going to show up on the books. Materials you have to pay out every month. You're literally having to write a check or exchange money for these every month. But if you own something, are you doing any accounting work? No, I don't constantly have to pay a rent payment every month, so I'm not putting it into the books as far as 900, okay? So this other 900, in this case, because we own it, 900 in rent, it doesn't affect us because we're not putting it into the books every month because we actually own the building. This would be an economic cost. The reason why we call it economic is because even though we're not recording it in the books, it's still a resource that has value that could be used. So for example, let's say I had a tractor. I could just have the tractor myself sitting there. It doesn't cost me anything, but if I was to give it to someone else and rent it to them, maybe I could be making money on it, okay? And that's sort of like this building. Even though I'm not paying for it, I could technically, if I'm not using it, rent it out to someone else, and so it does have a trade-off value there. It has an economic cost, okay? So let's go ahead and take a look and see what we have here. Total accounting cost is here. These will end up in the books. Labor, equipment, and materials, those all end up in the books. 800, 400, 300, that's going to be 1,500. Total economic, though, is what? Well, we're actually, as far as what we're economically using, is the resources of what we're paying out and the resources that we own that could be rented out to someone else or used for a different purpose, okay? So then I'd want to add that 900 in there, so it'd be 2,400. What is the new accounting economic cost change? The company sold the building and then leased it back. So if let's say I sold the building and then was leasing it back from a bank because I just wanted to have the extra cash on hand for something I was planning on doing. If I did that, then guess what happens? This cost we had before, all they're doing is changing this economic cost into a now $900 payment I have to make each month. Becomes an accounting cost because I actually have to make it to the bank because I'm leasing it back. So your total accounting is now what? Total accounting is 2,400. And then total economic cost. So all total economic costs is if there's any cost that we're still incurring that's not put in the books because we own something and that thing could be used for something else, would be there. But right now, based on the numbers, is there anything else it's telling us that we own and aren't putting into the books as far as what else it could be used for as far as value? Take a look at it. Are we accounting for each number? That's going to the books, that's going to the books, that's going to the books. This is now on the books because we're leasing it back from the bank and paying this $900 a month. There's nothing. So it's going to be 2,400. There's no other hidden economic costs as far as what they're telling us. Okay? This usually applies to people when they work for themselves versus if they were to pay themselves working for someone else. A lot of times that's what economic cost is talking about. Like I could work for myself and be like, oh look, I'm making some good money. But then if I was to compare it to when if I was to hire myself out to someone else, maybe I'm not doing so well because I'm not valuing my time in the business. Okay. So hopefully that makes sense to you. And that's all. That's all we have. So like if you're your own business owner, a lot of times people don't put their own hours in as far as an economic cost if they were to rent themselves out. Let me give you an example. Let's say I worked at the business 40 hours a week and I didn't pay myself anything. I didn't add it into the costs here. Then as far as economic costs, I'd have 40 times, let's say I could rent myself out somewhere else for $20 an hour. And then I just have 40 times 20 is what? $800, right? That's what happens with a lot of business owners because they don't realize like, oh, I'm making money, but also you have to realize that you're not paying yourself. And so you also have the money you could be making somewhere else. So if you were to close up shop, you could make $800 somewhere else and then sell your other stuff somewhere else. All right, that's it. That's the economic cost. Economic cost is anytime you have a cost that's not put in the books. That's basically all economics cost is. It's unrecorded costs or resources that you're not paying for but are using. So, all right. That's it. Take care.